Hey guys, time for another weekly video. And I tried doing this a couple of times, but I'm kind of at a loss for what to say here. Mostly because last week we didn't really do anything. We tried to go up, we tried to go down. We're right below last month's close, and nothing really is really happening. And we had some small reactions to the jobs data, first on JOLTS and jobless claims, which brought us down a bit. And on Thursday, we had a bit of a VIX crush, and on Friday we got the hot inflation, not inflation, unemployment and jobs, NFP data. And the data caused the rally in yields and a small one in DXY. And why this is important is because the past couple of weeks, this rally in equities, white here is US 500, and you can see that they are inversely correlated with yields and DXY. So if DXY starts to go up, in this case down, equity should go down as well. And why it's important is because this is a inflation or recession trade. What we've seen last week was the recession trade. Like the small pullback was that the Fed did too much, we are going to a recession, and the market reacted negatively to it. And as soon as the economic data looks better, we go into the inflation trade and equities rally a bit. But this this will resolve in a more decisive matter relatively soon. What we were looking to see is DXY, and DXY looks very bullish. It just needs a catalyst to go up. So it could potentially do something like this. Sorry, let's auto it and look at it here. We have a clearly defined range here. First is, I, I, I can move this one actually. So let's say we have this. This was a bit of an overshoot, the move here. And the top range is also clearly visible. I'll just make a thicker line. And the mid range maybe a bit higher here, something like this. Like this. So on the weekly, we have a positive divergence, a bullish divergence. To take this out, we have RSI making a higher low. This is the equivalent low, and most likely DXY will start going up again. It could also go down, but and cause an equity rally, but it's a lot more unlikely than that. So this would be the bullish case would be something like this: goes down, goes up, then starts going up, and keeps going until the range highs. New lows would mean this, and we're probably going to 95-ish or something like that, 97-ish. I would expect it to hold to this trend line. So this is an area where SPX goes to 420 or higher. And looking at yields as well, same kind of look. We lost this midpoint here, but if we have a recapture quickly, like the weekly did not close below it, it was still saved at the last second. So we have a hammerish looking candle here, but it's red. But if we start going up again on next week, it should go back to the range highs and also cause equities to drop again. So right now it's all about the economic data. Nothing is really happening. The setup in yields and DXY supports this. The setup in VIX supports this. So next week, what I would expect to happen is if we get a rally for CPI, I would expect to have a bit of a drop Monday and Tuesday, and maybe have another VIX move back to 20-ish. And then when CPI comes in, I would expect it to be on consensus, and it should get us another VIX crush. And when CPI comes at expectations and VIX goes down, we drop back to the lows. And this would basically be the setup for the bigger drop a bit later on, like this. But right now, we're going nowhere, and we have a bit of a range going on lower time frames. Let's zoom out a bit. So first things first, this is actually the mid-range. And then we have, let's say this. And this. Actually, the mid-range is a bit higher, probably like this. So we have to play this. This is not the time when big moves will happen because position doesn't really allow it, and the economic data is conflicting. The market doesn't know what to do, and we can basically tell this from what it's been doing. And we play it level to level. When we're at the range lows, we go long. When we're at the range highs, we short, and just profit from both sides. Don't be a bear, don't be a bull. Just go with the price action. And I'm assuming will open green because of Friday's update. As soon as we go above 410, we enter the short range. Here we didn't even get to the highs of the range, but it's plausible that we do. And let's look at the delta a bit for positioning to get an idea of how high we can go. So with the first day's close, we're at 47% ish. If we were to go at 415, let's say, let's see how high it would go. And we go to around 70%, slightly below. And comparing this to previous tops, we can see that we'll be at the same level as the uh, August high. Now going back a bit, let's see what 420 looks like. And at 420 we are at 100%. We are at equivalent positioning, bullish positioning at the top of the bull market, which is not really a good sign. So this is 100% a short. You can do it in size. You can just don't go too short dated if you go with puts. And just for the sake of argument, let's look at 430, and this will show I don't believe 440 is achievable. The way I've been talking about getting to 430, but the way I saw it was first of all with a larger pullback before we went for it, and over a longer period of time, like getting to 440 now is just absurd. Getting what I wanted to see for a run to 440 was a slow grind up until June. Now we're not even halfway to April, and bulls expect that we'll get 430. No, that's not going to happen. And looking at the delta positioning, we can see that it would 430 would turn the previous bull market top to become 70%. So it would be like 35% more bullish positioning than the top of the bull market, which is absurd. And it would basically double all the other uh, bear market rally highs. So it's just absurd. We're not going to see it. But at the same time, it's very, very unlikely that we have the big drop without some catalyst. And the catalyst has to be something completely unexpected. The market is relatively hedged, and it sort of allows a drop, but not quite, not a big drop. And what we want to get is either, let's say, a 3.7, no, 3.8, 3.9 unemployment print out of nowhere, that kind of thing. And we're not there yet, or I don't know, horrible earnings or something like that. But it's not in the cards from what I can see. And because of that, when is the market a buy? Well, at 395-ish, starting at 395-ish. Wait a second, so that we reset this level. And we can see that the dip was bought on the previous move down at around 10%. So I think intraday we were at 380, and this was like 7%. So we're looking to see the same thing here. At 394 we are at 15%. What we're looking is actually a bit lower. This is still a buy, like between 390 and 395 I think it's a buy. But it's a buy just to play the swings, because the market is range bound and it will go up, it will go down, will go up, it will go down until we have something concrete. And that something concrete is a lot more likely to be bearish than bullish, because of the economic situation. And at 389, so like 390, which is a major pivot for us, we would be at 10%. And keep in mind that actual positioning during intraday will be more bearish than this. So I would assume the more we go down, the more bearish it will become. And I think we will get an under 10% print on this if we were to drop to 390. Okay, so let's reset it and we go back. Yeah, that's kind of it. So don't be a bear, don't be a bull. Just play the ranges because the market is it's range bound. It doesn't do anything. And it's extremely difficult to know when it's gonna go uh, outside of this range. And again, because bullish positioning is so extreme, even if you get to 420, I don't expect to get a breakout. This is moving way too fast to be a decent move. To get a big move up, we need it to be a counter move, not an impulsive move. So this I will show on this. So let's assume we start from here. So we draw a midpoint on this chart. And how does it move? So this was an extreme move up, follow down, mid mean revision, go back down, mean revision, and we swing up the other way. We go down again, we swing up, we go down again, we swing up, and we go all the way above in the other direction. We go down again, we swing up, and so on and so on. But now we're not no longer swinging on the other side, and the swings are much lower. If we do the same thing on this, so let's assume the market situation change as of this point. So that, and we draw it like this, about the midpoint around this. So let's see where we get the energy. So it went up, it goes down, gets a bit of energy, goes up again, goes down again, got a bit of energy as well, and it will go down. It should top out at maximum 430. And when it gets to 430, it will collapse again because it has a lot of energy for a move down, and so on. But as you can see from this part here, it doesn't always go to the other side, to the extreme of the other side. So you can stop at any moment. And right now we are at the point where we're losing steam on the move up, and there is no energy from the swing down to take us up again. So this is kind of the way it looks for being bullish. It's a lot more profitable to play the swings, but it's more difficult. So for the first time, I don't have a bullish or bearish bias. I will just go with the swing. So when we get to the top for 15 or higher, short. When we go to the bottom, which I said is 395, 390, 395, go long, play the swings, and we see what happens next. Until we get new direction, either from the macro or from we have a clear breakout with momentum, with volume, and so on. Uh, it's not really worth it to take a strong directional positioning. Yeah, that's kind of it. See you guys next week. Have a good day. Bye bye.